Okay, in this video we're going to go through some debits and credits, my favorite. In order to understand QuickBooks or use QuickBooks, the most effective ways, you really should understand the debits and credits. Now, you don't need to know debits and credits necessarily because QuickBooks will tell it to you, but you need to be able to understand how to find them so you can know, oh, I debited AR, what should be my next step? I need to clear that. I need to create a credit somehow. How do I create that credit, right? So it kind of helps you to understand the workflow. So we're going to go into an invoice, and we're going to create an invoice with both inventory and non-inventory parts so we can see the effect. So I'm just going to create a new customer. Okay, and I'm going to add an inventory part to this. One inventory part, and let me make sure that it's positive. Okay, so positive inventory, and we'll add 5 as an example. Okay, and then we're going to go in and add a non-inventory part. So we can, a non-inventory part, a service item, an other charge, they all kind of function the same. So I'm going to add in one called freight in here. Now, before I add in and save this transaction, so freight in will say $50. Okay, so let's go look at COL 16. Okay, this item, so this inventory part. So we can see when we set up the inventory part, we have cost of goods sold as a cost of goods sold account, we have revenue as a sales account, and we have an inventory account, inventory asset as the asset account. Okay. Now, when we go look at our freight in, we have freight in as a cost of goods sold account only, right? We haven't made it a double-sided item. So I'm going to go ahead and make it a double-sided item. You want to make it a double-sided item if you will be purchasing this item as well as selling this item, right? Because if I purchase the item, I should be hitting cost of goods sold, or an expense account, or whatever it is. If I sell the item, I should be hitting some kind of sales account. So I'll call it miscellaneous revenue for freight. Okay. All right, so back into invoices. So now I have my invoice here, and I'm going to save it. Now let's go see behind the scenes what this does. So anytime you have any transaction pulled up in QuickBooks, you can go to Reports and Transaction Journal to see the debits and credits. Okay, so I'm going to get rid of some of these fields so we can take a peek. So what we have happening here, now this transaction journal also does not show quantity, right? It's just showing the total debits and credits. So if I needed to add quantity, I can come in and add quantity here as well. Okay, so what are we doing here? It's saying that we have debited accounts receivable. Get rid of one more of these. Debited accounts receivable, so that means our accounts receivable account went up by $157.50. Okay, because a debit means it's going up for AR. We have credited revenue for $107.50. So that's the sale, right, of the 5 ceiling fans. So that means that it went up because a revenue account, when you credit it, makes it go up. Okay, we've also credited an inventory asset account, which means it went down. Okay, so it's a asset account. When we credit it, it means it went down, right? Because we're relieving inventory at this time of sale. Then we also debited cost of goods sold for this inventory part, which means the the cost of goods sold went up. So a debit to cost of goods sold makes it go up. All right, so in this transaction alone, our sales is $107.50. Our cost of goods sold is $50, right? So what does that net out to? $57.50 in profit for selling this one item or these 5 items. So when you're thinking of debits and credits, you always, on the balance sheet side, so the asset or the accounts receivable, you always want to think there's going to be an offset to it. So in the accounts receivable case, $157.50, the offset's going to be when the customer pays. That's when that $157.50 will come out of accounts receivable. With the inventory asset, right, we're crediting it, so we're putting it negative. But when did it go positive? It went positive when we received the inventory parts in the first time. Okay? So inventory parts affect 4 accounts. It's always going to affect AR, unless you're using a sales receipt, of course, but some kind of cash or AR account, it's always going to affect revenue, inventory asset, and COGS. Okay? Now when we get down to the non-inventory part down here, this is saying that it's affecting cost of goods sold. Now, we had just changed this, right, so that the account that was being affected was a sales type of account. So when I go back to my transactions, let's go back into my invoice and take away freight in and add it back in again. Okay, and say $50 and save it again. Okay, now when I pull up my transaction journal again, it's hitting my revenue account, right? It's corrected itself now. But on this transaction, notice that the non-inventory part doesn't affect a cost at the time of sale, right? The time when the cost of this would come in is when we receive the bill from the shipping company, okay? So non-inventory parts, service items, etc. only affect accounts receivable and sales. There's no cost of goods sold or inventory asset accounts affected on those. Okay. So hopefully that helps to clarify and helps you to understand the debits and credits when you're dealing with inventory and non-inventory parts on a invoice.